Hello everyone, welcome back to your very own channel Money Playbook, where we discuss anything and everything about finance. In today's video, we are gonna talk about index fund or actively managed funds. So, out of these two, where should you invest your money? So, to dive deep into it and to understand where should you invest, let's understand what are index fund and what are actively managed fund. So index funds are passively investing funds where the index or mutual fund basically just copies whatever the stocks are there in Nifty 50 or Sensex or any indices that they follow. Since in this no stock selections is taking place, the cost or the expense ratio which we call is very low. So it helps is that it is a low cost investing with market linked returns. The thing is that in index funding, the objective is not to beat the market, objective is to match the market. Whereas if we talk about the actively managed fund, the objective is to beat the market. Fund managers actively buy and sell stocks. They aim to outperform the benchmark. For example, if a large cap fund is there, their objective is to beat the Nifty 50 market. So because of that, a lot of research is required and market timing is also required. Due to these all activity, the expense ratio is a bit on a higher side in actively managed funds. But since but if you look at it, the numbers are telling a different story. That is, actively managed funds have not been outperforming the index funds. Why? Because of all this actively index funding, because of this additional cost which they incur, that has resulted into a less compounding over the years. Now if you look at it, so though the expense ratio feels like it's only 1.5%, 2%, but index fund has as low as 0.3%. This 1.5%, 2% of annual fee destroys lakhs over decades. So it's not like active funds are bad and only index fund is good. So we should invest only in index fund. If you look at it, since in Nifty 100 or we call as the large cap market, the number of stocks from which the managers can pick is a very limited. Hence, outperforming the markets become a little bit challenging. Whereas if we go into mid cap and small cap, the number of stocks increases, which helps the manager to pinpoint identify which stocks can perform well in the coming years. Hence they can outperform hence actively managed funds can outperform the index funds. So overall, if you look at it, index investing is simpler. The thing is that you have less emotional decisions and all those things, low churns and few investing mistakes happen. So the thing is that index fund is comparatively simpler, whereas actively managed funds are a little bit complex. The thing is that you have to choose which out of which markets or out of which actively managed fund is actually going to outperform. So you have to do your own research before investing in that. Whereas index fund are just going to copy the indexes, so the chances of getting it being on a lower side is very less, since their objective is not to outperform but to match the benchmark. So out of which, if you look at it, what should you choose? So the thing is that you want both of those. Why? Because you want to have those actively managed funds to boost your return, whereas you want to have the index fund to have the stability in your portfolio. So on a general level, you should have a 70 to 80% of index fund, whereas 20 to 30% in active fund. That would be a better sort of allocation which can help you win over a long time. So market, all as we have all heard, market rewards patience more than predictions. We all know that timing the market is not easy, whereas staying in the market gives more return. Comment whether you prefer index fund or active funds. अगर आपको ये वीडियो पसंद आई हो तो लाइक और शेयर करें और इसी तरह की और वीडियोस के लिए सब्सक्राइब करें.